What is up, everybody? Dan again, Stocktrades.ca. Welcome back to the channel. Sorry I haven't been putting videos out as of late. I have been out of the office for quite a bit, and I am now back. I didn't really have time to set up my camera or anything this morning, so I'm just going to go over a quick recap of TD Bank's earnings, because this is a very interesting stock right now that's going through quite a bit of troubles, and they made a pretty big announcement this morning that is resulting in their stock being down around 4%. I think as I'm filming this, 3.43%. Earnings were relatively in line as to what was expected. They missed earnings estimates by a small amount, but they booked a big chunk of provisions for their anti-money laundering investigation, and they also had to sell off a chunk of their Schwab shares to be able to afford this, pretty much to maintain their CET1, which I will get to in a bit. But overall on the quarter, the AML update. So initially, this came to light earlier in the year. The company was going through some anti-money laundering issues, and the initial costs that TD Bank and many analysts had expected were anywhere from $500 million to $1 billion US dollars. So the company put aside $450 million, I believe it was back in April, to kind of as a provision. It's the same as a provision for credit loss for a loan that they believe will come unpaid. So this provision comes out of their net income. This is what they kind of expect the cost to be. So initially, that's kind of what was expected to cost the company. They maybe expected a little bit more, but then yesterday, after market close, right before the company reported earnings, well, actually, they reported earnings this morning, but they released this news after market close yesterday. They expect, they have taken a further provision of $2.6 billion, which they have taken more provisions in the past. So right now, I believe it sits at around $3.5 billion. And as the costs kept creeping up, and as more AML issues, anti-money laundering issues came to light, I believe there was an issue not too long ago about a particular worker there that was opening up accounts and funneling money out of the country. So that has resulted in possibly, more stuff coming to surface, more costs. And as a result, the company booked $2.6 billion, and they now sit at $3.5 billion. Over the last while, analysts have revised their estimates upwards and upwards and upwards, and we're now sitting at analysts expect the AML costs to be around $4 billion US dollars. It is not over. Regardless of what TD says, they say that TD expects that a global resolution will be finalized by calendar year end. There is very little indication as to when this will end, when the costs will end, when the added costs will end for TD Bank. And I do want to bring to light another issue for a U.S. bank, because keep in mind that this is U.S. TD Bank right now is at the mercy of U.S. regulators, and I want to look to Wells Fargo just to paint a little picture of this. So I believe it was 2016, Wells Fargo was pretty much caught creating a bunch of fake accounts, things like that. And U.S. regulators absolutely hammered down on them. So they put an asset cap on Wells Fargo that stated that the bank can only carry a certain number of assets. So this pretty much kneecapped them in terms of growth. And once the asset cap was placed in February of 2018, the stock was effectively dead money for the next, we're in 2024. We're talking 6+ years, this company did absolutely nothing. But it is still very possible that an asset cap is not out of the picture for TD Bank. And if this happens, it would no doubt impact their growth moving forward. So when you factor in that possible asset cap, and when you factor in the idea that costs have, as much as they like to say it has, costs, they are not guaranteed to be peaked here at $3.6 billion. We could exceed $4 billion. That is definitely a possibility. And there is a lot of uncertainty with this stock right now. And when I get to the valuation of some other banks here, you're probably going to get a better understanding of whether or not TD Bank is an opportunity right now. So if we go down to the actual earnings here, you're going to see some crazy deviances from actual reported earnings and adjusted earnings. And the reasonings for this is those booked provisions for the anti-money laundering costs. So what adjusted earnings for the most part do is they isolate earnings or expenses, that are deemed to be one-off costs. So they're costing the company money right now, but when they adjust them out, it gives you a better picture of year-over-year earnings growth. So the best way to explain this is if we compare TD's earnings, their reported earnings of a loss of 14 cents. This is primarily because of anti-money laundering costs, which are expected to be one-time in nature. So if we look to the reported earnings of a loss of 14 cents and we compare them to last year, you're going to see a gigantic loss in year-over-year earnings per share, which is accurate. The company has lost that much in earnings per share. But when you adjust those costs out, their earnings per share are effectively flat year-over-year. So when you isolate the AML costs, which are not expected to be recurring annual costs that are going to impact earnings every single year, you get this adjusted figure. Now, is it accurate to use adjusted figures in this situation? I would say yes, because you can isolate it out. You can see the growth of the underlying business that doesn't count these big one-time costs. Now, that is not to say that these one-time costs do not impact the company. It's just, it's unlikely to impact the company for a long period in the future. So I do believe adjusted earnings are a relatively strong point here when we can look at year-over-year growth, but don't get the impression that these $3.6 billion in costs don't actually impact the company. They definitely have. So as I mentioned, we're looking at flat earnings year over year. We can see here, again, they reported a loss of $181 million. When we adjust the AML costs out, we're looking at $3.6 billion in net income. And their CET1 fell to 12.8%, which I will talk about in a bit. So when we look to the actual earnings of the company, we can see they reported record revenue in two segments. They have, as I had mentioned, adjusted earnings of $2.05, which I thought was flat, but is actually up 5% year over year, which is not too bad. Provisions for credit losses come in at $1.07 billion. This is actually flat quarter over quarter, which is a good sign. It's up $306 million year over year, but this is largely expected. Provisions have accelerated over the last year. This is not unique to TD Bank. It's unique in the fact that TD Bank has reported some of the largest growth in provisions out of any of the major banks over the last while, but don't get the impression that TD Bank is the only bank that's reporting these large year-over-year increases. It's happening pretty much among all of them as the Canadian consumer gets weaker. The loan books are under more pressure. And realistically, the fact that they've only gone up, they've pretty much stayed flat quarter over quarter. That's a pretty good sign. Provisions are best, in my opinion at least, best utilized quarter over quarter. They're going to give you a better picture of the acceleration or the deceleration of provisions, because when you look year over year, the economy was in a much different state in the third quarter of 2024 to the third quarter of 2023. So quarter over quarter, in my opinion, is the better way to look at it. When we looked at Canadian personal and commercial banking, they have net income up 13% year over year. They have revenue up 9% year over year. So in their Canadian segment, loan volumes are up 6%, deposit volumes are up 5%, and net interest margins are down 3 basis points. Net interest margins are pretty much the difference in what the bank is making on loans relative to what it pays out on things like deposits, things like that. So it's down, but it's really not down all that much. We saw a quarter over quarter decline in provisions for credit losses, which is relatively strong because the Canadian arm of TD Bank was struggling for quite a bit. They were reporting higher provisions. So a $32 million decline is actually a pretty good sign. And overall, the Canadian end seems to be doing just fine. When we go down to US retail, that's kind of where we start to see things be not so good. So we've got a net loss of 1.7 billion. Again, this is all due to that AML situation. If we adjust net income, they have a profit of 942 million, but revenue is down 1% year over year. So they're seeing lower deposit volumes and loan margins in the United States. So personal loans are up 8%, business loans up 3%, but deposits are down 5%. Now, net interest margins of 3.02, that's actually up 3% quarter over quarter due to higher deposit margins. And when we look to provisions for credit losses, again, on a quarter over quarter basis, they actually reported a decline in PCLs. So that is a good sign. Again, year over year, plus 91 million, but that's not exactly the best metric to go after. So overall, the Canadian arm seems to be doing quite well on the retail end, while the US one is reporting a bit of a slowdown. When we look to wealth management, they reported record revenue. Net income was impacted by severe weather events because this would be their insurance segment. It's up 13% year over year, so they're witnessing higher insurance premiums, fee-based revenue, deposit margins, and transaction revenue. So the difficulty here is insurance service expenses are up 20% year over year. They're reporting, higher claim severity when we look at, things like the Toronto flooding, the Alberta wildfires, things like that. So I want to go to the CET1 ratio on the quarter. So the company reported a CET1 ratio of 12.8%. So effectively what the CET1 ratio is, in the simplest form possible, it is the amount of high quality capital that the bank must have available to pretty much be able to absorb a shock to the financial system, like say, a particular type of economic collapse, a big slowdown in the economy. They have to have a lot of this high quality capital so they can sustain that. And the regulators put in place an 11.5% minimum. So the company has to maintain 11.5%. If they don't, they have to generate capital somehow. We saw, I believe it was last year, the Bank of Montreal had to issue shares to shore up their CET1 ratio. And with the amount of money that TD is having to pay due to these anti-money laundering issues, they probably won't say it, but they were effectively forced to reduce their ownership in Schwab from 12.3% down to 10.1%. So they sold 40.5 million shares of their stake in Schwab. So what this will effectively do, expected Q4 impact to CET1 ratio from sales of Schwab to 54 basis points. So that in turn should boost this back up. It's fallen from 13.4% down to 12.8%. I do believe this is actually one of the weaker CET1s out of the other major banks over the last while here. And overall, by the looks of it, the bank seems to have shored up its provision for credit loss issues. It seems to be operating relatively well considering the overall circumstances of the U.S. and Canadian economy. Its Canadian arm seems to be doing just fine. Its U.S. arm is a bit flat right now, but overall, a lot of people are asking me right now if TD is, a buy on the dip. And in my opinion, there really isn't all that much of a dip here. Sure, we've got a dip post earnings and the stock has been, relatively flat for the better part of 2 years. I believe if we look at total returns over the last 3 years here, I mean, we've seen TD 7.88%, which is better than Bank of Montreal and Bank of Nova Scotia. But realistically, considering, if we even let's add the TSX into here and let's just go SPY, or let's go S&P 500. We're looking at a 22.2% return from S&P 500, 23 from the TSX. So in this situation, they've underperformed the index by quite a wide margin, and they've gotten absolutely thrashed by the two banks. The two, what I believe are the premier banks in the country, that being National Bank and Royal Bank. They are the two banks that I own. I pretty much sold Toronto Dominion Bank as soon as these AML issues came to light, and I just funneled it into my Royal and National positions. But the one thing I wanted to mention on the whole buy the dip thing for Toronto Dominion, how it's struggled over the last while, the one thing I will highlight is the fact that this bank is not really all that much cheaper than any of the other institutions. I mean, we're looking here at a price to earnings ratio. We're looking at 13.25 for Toronto Dominion. National Bank trades at a discount to TD on a price to earnings multiple. It's trading at only 12.3x, and Royal Bank trades at a slight premium, 14.1x earnings. So for those who are thinking, because TD Bank has traded flat over the last years, it's at somewhat of a bargain. When we look to on a price to earnings basis, which is a relatively accurate way to value these banks, price to earnings would be the multiple I would be using to value these banks. It's not really that discounted at all. I mean, it's cheaper than Bank of Montreal and Royal. Royal, I am more than happy to pay the added premium for. I believe it's a better bank. National, I would be much happier at 12.3x earnings over 13.25. So on a price to book basis, which I believe is another solid way to value banks, this is where it does get a bit trickier. I mean, Royal Bank and National Bank trade at a higher book multiple, but this is highly likely because, they are higher quality banks. They will trade at a higher book multiple, whereas TD Bank is currently trading at a premium to something like Bank of Montreal and Bank of Nova Scotia. So to answer the question that I've got a lot recently, is Toronto Dominion a buy on, a flat share price over the last while? I don't really think so. When we look to earnings estimates, they do expect, a reasonable amount of growth moving forward. But, I mean, we're looking at earnings per share of $8 in 2024. They only expect them to be $8.36 in 2025. This is, what would this be? Just a little under 5% earnings growth, not even. So they effectively believe that it is going to not really grow earnings all that much in 2025. When we look to 2026, they do expect a big rebound in growth. But the fact is, 2026 earnings are very hard to predict. Whereas if we go to a company like National, who, keep in mind, is trading at a discount on a price to earnings multiple, we can see that the earnings growth here is expected to be largely the same, despite not having a plethora of issues with it when it comes to those AML investigations, which are largely unknown. And one of the main reasons that National probably is expected to grow earnings at a relatively low multiple, we're looking at a little less than 5% earnings growth right now, is just the fact it's relatively overexposed to the Canadian economy. When we look to a bank like Royal, we're looking at around 2024 earnings expected to come in at $11.63, which is it's flat relative to last year. But when we look to 2025 expected earnings, they're expected to grow by around 8%. So you're looking at double the earnings growth relative to a company like TD and National. Similar earnings growth for National, but also a lower earnings multiple. Overall, for me, there's too much uncertainty here with Toronto Dominion. Do I view it as a bad company? No. I don't view this as, a disaster, a falling knife. It's going to fall another 20, 30%. But I do think that these AML investigations, the company thinks they will come to a resolution at year end, which they might, but nobody knows what the end cost will be, the end punishment, the end, results, the impact of future earnings will be. So for that reason, I would personally, and obviously I can't tell you how you invest if you want to buy TD on the supposed dip, even though it's really not that much cheaper than any of the other banks. That's fully up to you. But in my opinion, I personally would rather just buy better banks at similar valuation multiples. I don't really see TD Bank as that big of a bargain at this point in time. So everybody, that's pretty much it for the video. As always, like the video, subscribe to the channel, join the No BS newsletter down below, and we will see you in the next video where hopefully I will get my face back on camera here and I will be providing rock solid Canadian content for investors.